Inflation, recession, rising interest rates. It seems like that is all anyone is talking about. So today in this video, we're going to dive into all of that and how is that affecting us down here in the South Florida real estate market. Are we heading for the dreaded crash? So stay tuned and we're going to talk about that today. Hey, what's going on, everybody? Welcome back to my channel. My name is Rob Zeoli. I am a real estate agent right down here in South Florida. And if you're looking for a channel that's going to show you what it's like to move to live, to play, to work here in South Florida, then this is definitely the place for you. So don't forget to subscribe to the channel and tap the notifications if you want to know anytime I go ahead and put out a new video. I have a real passion for putting these videos out, but more than that, guys, I am a licensed realtor, and what I love more than anything is helping people just like you with their real estate needs. So give me a call, text, email anytime, and I look forward to helping you with any of your real estate needs down here in South Florida. So again, today I just wanted to talk about the real estate market with all the buzz going on and all the the stories in the media about the market, inflation, recession, everything that's being talked about. A lot of people, a lot of buyers are wondering, are we in a housing bubble, and are we about to repeat what happened to us in 2008. Now, as the market shifts, it's only natural for people to be concerned, especially buyers, but there's real concrete data out there to show that what's going on now is nothing like what happened back in 2008. Now, without a doubt, there are a lot of things going on with the economy. Again, we have inflation, the interest rates are going up, and recession. So anytime the powers that be, people that are running stuff, change or try to change the definition of a word that has been used forever to define or gauge the economy and what's happening and what we need to do, or if we're doing a good job, you know that we have some issues. So we're going to dive into all of that today, where we are and where we're headed, especially in regards to what's going to be happening with the real estate market here in South Florida. So to start with, the Federal Reserve has just raised interest rates back in July by 75 basis points, and this is the second consecutive hike. They did the same thing in June, raised it by 75 basis points, bringing the current rate to 2.5% to 2.5%. And that's the first time in history that the Federal Reserve or the Fed has done that, raised it twice consecutively like that. So what does that mean for the real estate market? So the Fed's fund rate is basically the rate at which banks pay to borrow money from each other and from the Federal Reserve. So when the rate gets raised and it costs them more to borrow money, they pass on that charge to the consumer. So anything as far as buying a car, buying a house, it's going to cost us more because they're going to raise the rate on the end user, the consumers. So this is going to make things more expensive, and that basically shrinks the potential pool of potential buyers. Now, the real estate market is always driven by supply and demand, and really what caused the prices to go up so much in the last, say, 18 to 24 months was a very, very low supply. You've heard, or everybody's heard, the low inventory or an inventory crisis when it comes to available homes. And in turn, that drove up the prices because there was way, way more demand, more buyers than homes for sale. Now, the Fed's goal here clearly was to cool off the housing market, and it's working. Anybody who's out there selling real estate on a daily basis or paying attention to the market can see right away, and sales have been down around 25% on average in the last couple of months. And basically, when you reduce the pool of buyers by making things more expensive, things cool down and more people put homes on the market, bringing up the inventory. And traditionally what happens is people start lowering the prices and you're evening out the market. So again, we're seeing this exactly play out in real time. Now, the real question is, with all the economic indicators that are out there right now, interest rates rising faster this year than they have in the last 30 years, inflation is at, I think it's 9.1%. And the Fed funds rate is at 2.5% to 2.5%, which is actually still historically low. But what does that mean for the real estate market here in South Florida? Are we going to see continued growth, or are we going to contract And is that bubble going to burst? And are we headed for a market crash? Now, again, everything has to do with the supply and demand. And we really have nothing to compare this to other than our last market crash. So let's look at the data from 2008, around the time of the last market crash, and see how that compares to what we're looking at right now. So again, we're going to be looking at the inventory right back during our last crash of 2008. And another thing to note, the real estate or real estate as an industry has been around for well over 200 years. And one of the main constants in that is that they've been using the supply, demand, and months of inventory to determine what type of a real estate market we're in. So hopefully they don't change the definition or try to change the definition of this. But it's very interesting and very, very telling to look at the difference between then and now, and what we can be looking towards in the real estate market, you know, say in the next year or so. So if we look here at the chart, the supply of homes, stark difference between the supply and demand, the months of inventory, the available inventory between now and around 2008. So even as early as 2009, you can see there was 4.8 months of inventory. And months of inventory means if we just turned off the spigot right now and nobody listed another home, it would take whatever the months of inventory, that's the amount of time it would take to buy up every one of those homes. So if you look between 2007 and 2010, we went as high as 10.4 months of inventory. Right now, nationally, we're at 3 months of inventory. And that's different than South Florida because where you are geographically, it's going to differ from the national numbers. Now, in this chart, this is for the greater Fort Lauderdale area, and you can see June 2022, it's a seller's market. So months of inventory based on closed sales in June was up 38.8% from the month prior to the month before, which was May, and up 38.3% to last year. And under that, you can see clearly how they determine what type of a market we're in. So buyer's market is more than 6 months of inventory. Seller's market is less than 3 months of inventory, and a neutral market is between 3 and 6 months of inventory. Now again, in this chart, you can clearly see where it says months of inventory based on closed sales in June 2022 is 1.8. So significantly lower than the national average of 3. So we are still in a seller's market, a pretty strong seller's market here in South Florida. Now in this chart, we're going to look at the foreclosure activity between the last market crash, 2008 through 2015. We can look at the numbers here. You can see they were as high as 2.8, 2.9 million in 2009 and 2010. Last year, 2021, there was only 151,000 foreclosure filings. The big difference with this, and why this is very telling, is that back during the last crash, there were so many homes that were completely over leveraged and there was no equity in the home. So sellers had no choice and really had no skin in the game other than their credit score. And when prices adjusted, they had no equity to sell. So basically they dumped the properties, they took a big hit on their credit. But now in this market, most people, 95 to even more than that percent of the people that are buying homes now have built-in equity. And we're not talking about just price appreciation. We're talking about people that are buying cash. There is no, there's no way to file a foreclosure proceeding on someone that owns the home outright. Unless they don't pay their HOA dues or they don't pay their taxes, there's nothing to foreclose on. And people that are financing, they're still putting down 20-25%. So totally different when it comes to foreclosure activity. And this is another very telling sign that does not look anything like our last crash. Now this slide is another interesting one because it goes over our last recessions. I think there are 6 of them, and what happened to home prices during those recessions. So you can see the ones in 1980, homes went up, appreciated 6.1%. 1981, 3.5%. 1991, that recession, home prices went down by 1.9%. 2001, home prices went up by 6.6%. 2008, which was our last recession during the big housing and Wall Street crash, home prices went down significantly, 19.7%. A lot of foreclosures at that time. And 2020, with COVID, when COVID hit and we went through that little recession during that year, prices still went up by 6%. So being in a recession does not necessarily equate to having a housing crisis or crash. So with all this available data, it's kind of plain to see that we're not at this point heading for a crash. We are in a correction phase. What we went through during COVID and after COVID with the Fed dropping their rates the way they did, and interest rates were, it was like free money, in the 2% range. That was to get us out of the pandemic. And now we're kind of out, and the Fed is making it clear that we have to stabilize the housing market. It just has to happen. So I get a lot of questions about prices going down. That doesn't mean that homes are not appreciating. What that means is that sellers that think that they can just demand any number or any price for their home, that's not going to be happening anymore. But a home that is priced right is going to sell. We're still having multiple offers on certain homes, but there are some sellers that are reducing their price because they're asking too much. It doesn't mean that a home that was bought last year for, say, $700,000 is going to be selling for $600,000 this year. That's not at all what's going on. We are still appreciating, but just not at the same rate. Now, this slide here really puts it into perspective, and this is done by several experts, companies that really crunch all these numbers. So if you look here, housing market forecast for the rest of 2022. So as you can see, it says here the housing market is shifting away from the intensity of the past 2 years since COVID, and again, the rates that were, artificially lowered to spur on the economy and, housing. And the experts are projecting what's going to happen for the remainder of 2022. So this is coming from Fannie Mae, Freddie Mac, NAR, all the experts that put out these numbers and do all the research. And nationally, home prices are projected to rise more moderately than last year, but they're not expected to fall. So prices nationally are forecast to climb by an average of 10.3% this year, or for the remainder of 2022. So basically, the long and short of it is that if inflation keeps going up, the Fed has already said that they are going to continue to raise the interest rates in order to bring inflation down to a number that is manageable. Right now, it's still too high. It's 9.1%. So no one really knows what's going to happen with these numbers. And so basically, if it keeps going up, they're going to keep raising interest rates to try to put, a ceiling on the inflation and bring it back down. Now, if you look at the bottom of this same chart, home sales would moderate. So all the experts are forecasting that home sales will be going down this year, the amount of sales, due to higher mortgage rates. Things are more expensive. They shrunk the buyer pool. It's already happening. Home sales are down 25%. So the prediction is we're going to be going back to pre-pandemic years, the same type of market dynamics of, say, 2018, 2019. The only difference is that home prices have, appreciated significantly during that time or from then to now. And that is throughout the country and here in South Florida. But again, we're just heading back to a normal market. My prediction, I agree with all the experts, we're not heading for a crash. The market is just going to correct. It has to correct. There's no way that it could have been on that same trajectory with interest rates in the 2% range and home prices just, going through the roof. They had to stop somewhere. So no crash, but back to a normal, neutral type of market in, say after 2022. Okay, guys, so we're going to wrap it up right there. And I hope this video was helpful. I hope you got something from it. And again, if you have any questions at all about South Florida real estate. If you're looking to buy a property, I look to make your transition a very, very smooth one. You could reach me by phone, text, email, send me a direct message, leave a comment and a thumbs up on this video. I would really appreciate that. It helps with the YouTube algorithm, and I'll see you guys on the next video. Again, I appreciate you watching. You take care.